Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to be showing you how to sell covered calls in order to generate income. Now, if you're new to options trading or you're trying to use options trading in order for you to generate some extra income while still maintaining your regular 9 to 5, then you should definitely consider options trading. And you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to be showing you how to make consistent income using one of the best option strategies out there, known as the covered call option strategy. Now, before we go ahead and get down and dirty with options, I want you guys to do yourself two favors. Always make sure to do your own due diligence before investing. The next thing I always require of my subscribers and my viewers is that you always make sure to have an exit strategy before entering any options trade. That being said, let's go ahead and get down and dirty with options. Now, for today's video, we're going to be using Trade Desk, ticker TTD. So let's go ahead down here and we're going to go into Trade TTD options in order for us to open up the option chain. Now, the option chain, for those of you new to the channel or new to options trading, is going to be represented by this area down here. All this area down here makes up the option chain. Now, what the option chain does is that it allows us to make a more informed decision. It gives us enough information in order for us to execute a proper contract. Now, on this channel, we specialize in helping small account portfolio grow consistently over time. So if that's something you guys need help with, then go ahead and check out the link in the description below. Now let's go ahead with the covered call option strategy and how to use that in order to generate consistent income. Now let's start off by showing you what the covered call option strategy is. For the cover call option strategy, one of two criteria absolutely must be met. Criteria number one, you must be able to own 100 shares of the stock. If you are unable to own 100 shares of the stock, then you must meet criteria number two. And criteria number two is that you must be able to control 100 shares of the stock. For today's video, we're going to be focusing on you owning 100 shares of the stock. So currently, we're going to be under the impression that you own 100 shares of TTD and you bought that today, right now, at 48.77. We're just going to round it up to $49 per share to make the math a lot easier. Now that you own 100 shares of TTD or Trade Desk in your portfolio, now you're going to go ahead and use it to make consistent income. And to do that, you must first go to sell. You're going to go to call, and then you're going to choose your expiration date. Now, the expiration date is a matter of preference, and those preferences can be the amount of time you want to execute this trade, the overall goal of your portfolio, how much income you're trying to generate. All those things are key factors before choosing a strike date. Just for the purposes of this video, we're going to be doing what's known as weeklies. So we're going to be going with April 25th, which gives us around 11 days. So you could do weeklies, you could do bi-weeklies, you could do monthlies, or you could go further out. So let's go ahead with weeklies. So now that you have selected your sell, you have selected your call, because selling covered calls means that you sell a call, and you have your strike date. Now you're going to go ahead and choose your strike price. Ideally, in order to maximize the efficiency of this option strategy, it is highly advisable that you choose your strike price above the share price that you bought the 100 shares. So anything above the $49 per share price is going to be perfect for you. So let's go ahead and choose a strike price. Now I will be going with the strike price of $54. I will come back to explain to you what are some of the reasons why I chose the $50 strike price. Again, that one here is a matter of preference. Now, with the $54 strike price you see here, that's going to give us an 85% chance of profitability. As we can see, chance of profitability to the top. Now, with $54 strike price and 85% chance of profitability, you're going to be getting paid because the whole point of selling covered calls is in order for you to generate income. The amount you will be getting paid is going to be 0.50, or in real life, that's going to be equal to $50. The reason for that is that each option contract contains 100 shares. So you simply multiply zero point 0.5 by 100, and that's going to give you $50. When you go ahead and you select that contract, you're going to see none other than the covered call option strategy. Now, back to why I chose the $54 strike price. Well, it's quite simple. So, we under the impression that we picked up 100 shares of Trade Desk at the $49 per share mark. So, if you able to sell a covered call at any price above this right here, you're gonna be making profit. However, the reason why I chose the $54 strike price is that I want to choose a strike price that's high enough away from the share price so that my strike price does not get triggered. And I will go over how it's going to get triggered shortly. So that's why I chose the $54 strike price. Now, the other reason I chose a $54 strike price is that I can go ahead and choose a strike price a bit higher than 54. But then what that's going to do is that, let's say we go with the $56, now that's going to lower the amount of income I'm going to be getting. So instead of $50, I'll now have to settle for $26. So the higher the strike price you choose, the higher the chance of you getting assigned. Now, the lower the strike price you choose, the easier it is to get assigned. However, the trade-off is you make a lot more income. Hence, I started off by saying the $54 strike price is a matter of personal preference. It's going to be determinant on your income goals and your overall portfolio outlook. Now, we're going to go ahead and we're going to break down this trade. Now, the covered call option strategy is what I like to refer to as a win-win option strategy. The reason that it's a win-win option strategy is that no matter how the trade goes, you win. There's only one single way you could lose with this option strategy is if you choose a bad stock. That is literally the only way you could lose with this option strategy. So be very selective with your stock choice. Now, here is one way this trade could go. Come expiration date of April 25th, if this share price right here goes past your $54 price right here, then you're gonna be assigned. Assignment means is that now you're gonna lose your 100 shares that you use as collateral in order to sell a covered call. Now, I did say this is a win-win option strategy. So the first win you're gonna get is that you're gonna be able to lose your 100 shares, which you use as collateral. However, now you will have an income in your portfolio of $5,400. When you are assigned, you will be forced to sell your 100 shares at $54 per share, netting you $5,400 in your portfolio. So now you lost your shares, but now you have income equaling $5,400. That's one win. Now, the other way this option could go is that, once again, come expiration date of April 25th. If this share price right here is trading anywhere below the $54 strike price right here, then you get to keep your 100 shares in your portfolio. Now, I did say this option strategy is a win-win option strategy. So here's the other win. Now that you're able to keep your 100 shares you were not assigned, now you're able to go ahead and keep selling consistent covered calls on a weekly or bi-weekly basis in order for you to continuously keep generating this premium right here. And this premium right here is what's used to grow your option portfolio slowly, consistently over time. That is one of the beautiful things about selling covered calls for income. Now, the whole point of selling covered calls for income is that you want to maintain your 100 shares in your portfolio as long as you can. If you do get assigned, you're no longer able to generate consistent income. So, to sell covered calls for income, your strike price is going to play a pivotal role. Once again, choose a strike price that benefits you in several ways. Choose one that has a very high chance of profitability, so it's harder for you to get assigned. However, not so high that you're not able to make a decent premium. And that right there, in its essence, is how you use the covered call option strategy in order for you to generate consistent income. If you guys have any questions concerning the covered call option strategy, let me know in the comments below. The majority of my portfolio is selling covered calls, so I do have a bit of knowledge on how this option works, and I always keep winning. If you guys want to see the amount of money I make on a weekly period, go ahead and subscribe to the channel. I usually make a monthly update every single month consistently to show you when I'm making consistent gains or when I'm making losses. Now, for those of you guys that made it to the end of the video, I'm going to give you guys a little bonus. I did mention there is 2 criteria that need to be met in order for you to sell covered calls for income. Now, the entire video was going over you being able to buy 100 shares of a stock. Now, if you are unable to buy 100 shares of a stock outright, let me go ahead and show you a hack that's going to allow you to control 100 shares. So we're going to be using the exact same stock, which is Trade Desk. And in order for you to do that, you're going to go to buy, you're going to go to call, and then you're going to go ahead and choose a far out expiration date. Just for the purposes of this video, we're going to be using January 16th, 2026. Now, for this option strategy, it's better if you choose your strike price below the current share price, and we're just going to be going with a $45 strike price. This is just an example. Do not do this trade. Now, with the $45 strike price, I'm going to have to pay $13.50 per contract, which is going to equal to $1,350. Remember, each option contract is multiplied by 100 shares. So now I'm able to control 100 shares. Now, why would anyone want to do this? The reason why someone would want to do this option strategy is because, let's say you do not have $4,800 in your portfolio, but you want to trade desk, then you simply buy an option contract that's going to cost you a third of the cost. And then you could use this option contract as collateral in order for you to go ahead and sell covered calls. That's a hack that I too have been using in my portfolio for more than 5 years now, and it keeps working. So let me know if you guys are using this option strategy, which is known as buying a long call or a leaps option. Now, go ahead, like the video, subscribe to the channel. Now, go ahead and share the video with someone that needs help growing a small account portfolio. Now, as you guys know, I did mention this on this channel. We specialize on using long-term option strategies in order to make short-term gains. And we do that by helping grow small accounts portfolio consistently over time. Now, until the next video, keep pushing your investments.